Fasten your seatbelts, folks. The investment landscape is shifting, and you're right here to witness it. Let's kick off with a recent development that's been making waves. Hargreaves Lansdown, a household name in the investment world, has decided to reduce its share of interest earned from customer balances. Now, this might seem like a minor adjustment, but let's delve a little deeper. This change comes as a response to comply with regulations, an element that's crucial in the financial industry. When we talk about regulations, we're referring to the rules and standards set by authorities to maintain a fair and transparent market. These regulations are not just simple guidelines, they are legal obligations, and failing to meet them can result in serious repercussions. Now, what does this mean for Hargreaves Lansdown? The company's pre-tax profits fell by 8% to £182.5 million, with shares dropping by 7.2%. In the first half of the year, Hargreaves had kept a cool £132.8 million of interest earned from clients' balances, marking a 9% increase from the previous period. But with the new compliance measures in place, this figure is set to change. It's also worth noting that while this decision has led to a slight decline in new customer numbers and business growth, it's a strategic move that underscores the importance of regulation compliance in the long run. It's a reminder that in the world of finance and investments, playing by the rules isn't just an option, it's a necessity. This move by Hargreaves Lansdown sets an interesting precedent in the industry, and it's only the beginning of this roller coaster ride. Just when you thought you had it all figured out, here comes a curveball from the Democrats. Yes, you heard it right. The Democratic Party has introduced a new legislation imposing a 1% tax on share buybacks. This move is part of President Joe Biden's climate and tax bill, and it's sure to shake things up in the investment world. So, what does this mean for investors and companies? Well, it's a bit of a mixed bag. On one hand, this tax could potentially create a headwind for investors. After all, US companies have been heavily engaged in buybacks, with S&P 500 companies projected to spend around $1 trillion on buybacks in 2022. This means that the new tax could potentially reduce the amount of money that these companies have available to return to shareholders. On the flip side, the tax could also lead to a shift towards increased dividends. Companies might find it more beneficial to distribute their profits directly to shareholders in the form of dividends, rather than buying back their own shares. This could be a silver lining for some investors, especially those who rely on dividend income. However, the introduction of this tax has not been without controversy. Critics argue that buybacks primarily benefit shareholders and executives, often at the expense of future investments in workers and machinery. They believe that this tax could help to redirect resources towards more productive uses. But, as with any new policy, the proof will be in the pudding. It's going to be interesting to see how companies and investors react to these changes. Will they adapt their strategies? Will they find new ways to maximize their profits? Only time will tell. This tax is sure to stir the pot, and it's going to be fascinating to see how companies and investors adapt. It's a new dawn in the investment landscape, and we're all eager to see how it unfolds. Meanwhile, across the pond, ASOS is making waves with its successful turnaround plan. Amid a challenging retail landscape, this online fashion giant has managed to return to profitability, even in the face of declining sales across all territories. It's a classic tale of strategic ingenuity and resilience, and it's one that's worth delving into. So, how did ASOS pull off this impressive feat? Well, the magic lies in their strategies for profit optimization and cost savings. By focusing on profitable sales rather than just chasing high sales volumes, ASOS has significantly improved its earnings before interest and taxes, as well as its profit per order. This shift in strategy is a clear indicator of the company's commitment to sustainable growth and profitability, but the strategy doesn't stop there. ASOS is also keen on reducing its inventory and improving cash generation. By right-sizing inventory, the company is able to avoid overstocking and the associated costs. This is a proactive measure that helps to boost margins and enhance financial stability. As for cash generation, it's the lifeblood of any business. With recent cash injections and a maintained full-year guidance, ASOS is well positioned to navigate the unpredictable waters of the retail sector. Analysts view these operational changes as a positive offset to external challenges, providing a much-needed stability in the company's financial outlook. ASOS's comeback is a testament to the power of strategic planning and effective execution. It's a reminder that even in the face of adversity, businesses can thrive with the right strategies in place. Investors, take note. This is a prime example of the opportunities that can arise when a company is willing to adapt and innovate. It's proof that there's always potential for growth, even in the most challenging of times.